But we're here to talk more really about the results that we've seen coming through. And Ron from SA Stockbrokers is particularly keen to talk about KDs as well as Protect Kutele. Let's begin at KDs. KDs, we saw them battening the hashes literally, as it were, at the worst of the downturn. And these results begin to show that that effort seemed to have worked. Are they beginning to come into your zone of buy?
I think so, Godfrey. Yes, a couple of weeks ago we spoke about Coronation, not a dissimilar business model, but it's far bigger in terms of assets under management. I think KDs is certainly starting to show what they can do. They've got four their funds in the top 10 of unit trusts. They are starting to grow their private sector business or private clients business away from the institutional business. A very, very good set of numbers. Obviously, you're taking a view on the market when you're buying KDs. I think their management is absolutely superb. The dividend yield is about 6.5% with a PE of a like sort of amount there. Yeah. The share price run about R3.40 odd. Not expensive. You've got to take a view on the market when you buy.
So there is value in that stock, you would say?
I believe that there is value. Yeah. It's a stock which you buy and you put away for a year, 18 months. Yeah. Yes. Not expensive, is a very, very nice one for a re-rating going forward.
Sure. Now, at the peak of the downturn, March 2008, we saw them cutting salaries and putting a freeze on headcount. Now, if you are saying they're now trying to expand their business more into the private sector, does that mean they're beginning to look at that headcount again and perhaps some of the salaries are beginning to get a little nicer again?
They are now given increase in salaries. They've expanded their headcounts there, Godfrey. We are seeing them growing their business. It's a very tough, challenging area. But certainly, yes, it's one which I certainly like. It has got prospects going ahead.
What do they need to do in your book for them to really take full advantage of the current circumstances that we're seeing? I like to look at the situation where we are now to where we were in March. I think it was March 2006. I think before that huge bull run that we saw. Because we're sort of really at the cusp of an upturn, isn't it? If Greece does not spoil things.
That's a million-dollar question there, Godfrey, in terms of Greece. Yeah. Are we going to see any contagion? Yeah. Greece in its own context is very, very small relative to EU. If they can stop that contagion and a major spread and the whole knock-on effect, then I think markets are going to move ahead. We're going through a period of uncertainty at the moment. The US is growing strong. Corporate profits are looking good. The whole macro outlook in the US is certainly looking a lot better. Yeah. We are seeing some slowdown in China. But I mean, if China was previously growing, let's say 10.5%, and they're now going to grow at 8%, that's not a major trend smash. The Far East will still be, in the emerging markets, will still be the engines to drive global growth.
So KDs definitely would be a stock to buy. But I worry about the word that you used. You said if we're able to stem, in other words, stop the problems in Greece. Now we saw BP's efforts in the Gulf have not been able to stem the flow of oil into the Gulf. So we get worried there. But let's move on to where perhaps the government here can do something. Let's talk about Protect Kutele. Those results come, revenue increase below double digits, margins under pressure, competition increasing. Is this one that you'd be accumulating now ahead of an expected increase in government spending?
Very much so. I think that the business model is superb. They've moved away from the areas which have been affected by the downturn, such as civils and bulk earthworks. They've moved that all into mining, particularly coal mining, where there's major expansion. Exports to China, to India, to the Far East are really very, very, very strong indeed. Their fleet is one of the youngest in the industry. It's about 1 year old. They change their fleet every year or two, compared to their peers of about 6 years of age. That means major efficiencies are coming through. They've signalled the period ahead, although challenging, with a maiden interim dividend of 4 cents a share. The share is currently, at current prices, about 76, 78 cents on about a 3.5 PE and a dividend yield of 5.5%.
So it's clearly one that you like.
I think it's one, yes, to buy and to put away.
Sure, but when you get the CEO beginning to complain about government inability to perhaps roll it out, you get a sense that, you know, they are under pressure because they would like to see more coming out of government and realize if that doesn't come through, it could be
the $1 million question there, Godfrey, what happens after the World Cup?
Yeah.
Service delivery is absolutely essential in this country. We have to build schools, clinics, roads, housing, and the like. When that starts to happen, we'll see their order book expanding in the areas where they've seen a massive downturn up to now.
So Ron Klipin's message is accumulate.
Accumulate, yes.